The increasing appetite of bonds as a tool of capital raising has seen nearly 30 billion shillings raised by various firms in the country. I sat down with John Gachora, the Group Managing Director of NIC Bank, following the successful listing of a 3 billion bond by NIC at the Nairobi Securities Exchange. What is driving this demand?
So I guess it's on two levels. One is that I must say you're right. I mean, we have seen really good deepening of the financial markets, or the capital markets in East Africa. The demand that we have seen, I mean, if you look at our bond, we went thinking that we will raise 3 billion. Mm-hmm. We've had to upsize to 5.5 billion.
Right. And
in fact, we were listing at the Nairobi Stock Exchange this morning.
Right.
But we received offers close to 7 billion.
Right.
And when I went around speaking with the investors, I think what was very clear, one is that there is a pretty attractive interest rate environment. And there's a view that interest rates will come down over time. So this is a good time to pick up what I'd call well-priced paper.
You're looking at 3 billion for the first tranche. It was oversubscribed to 6.5 billion shillings.
Yes.
Obviously a clear indication of where the market is heading.
Yes.
And you've alluded to your the use for the funds is to raise your client base. But in terms of specifics, what are we looking at?
So specifics is that obviously this is going to count towards what you call a tier 2 capital, right? And a tier 2 capital, as you know, one is that the Kenyan central bank has asked all the banks to raise their requirement, their capital requirements, by creating a 2.5% buffer. So first of all, there is that requirement that we must all meet January of next year. Mm-hmm. But for us, what was more important was the growth story. So what we have been a really strong bank as far as corporates are concerned. We've also been a very strong bank in asset finance, which we are known for. What we have not done extremely well in is in retail and SME segments. So we want to become significant players in retail and SME segments.
Before you go into your expansion strategy, you just alluded to the regulation by the CBK. Yes. What does it mean for banks in the lower tier?
Well, it's, you know, the good thing is a percentage,
right,
as opposed to a magnitude. So when it talks 2.5%, if you're small, then 2.5% of a small number is still a small number.
Right.
So I think most banks will be able, I'm quite confident that almost all Kenyan banks will be able to meet that. So you're not going to be seeing
a lot of cannibalism, especially by the
this will not cause it.
banks.
This will not cause it. What might cause it is there was a story, I guess, last week where the central bank said that they are thinking about relooking at the minimum capital requirement. So the minimum is the magnitude. Currently in Kenya, the minimum is 1 billion shillings. If you're 1 billion shillings of capital, you can start a bank.
Right.
That's much lower than what I would call our tier countries, right? And I think what the central bank has signaled is the fact that, you know, regulators need to start looking at that number. We have, you know, a large number of banks in this country. And there is a concern that as local banks, many as we are, will continue fighting for the smaller opportunities. When the bigger opportunities, the infrastructure opportunities come up, we have to go overseas and bring these foreign banks to assist us because our capital is small. And I think there is a feeling therefore, there's an emerging feeling that, you know, people need to start thinking about how do we create really large banks that can support these mega projects that the government has embarked on. Still on your business strategy, this is the first time we're seeing NIC going for debt and equity. Yes. Why? Well, we thought, you know, historically we have been funded through equity, which is why we had the rights issues that we did. This time, when we looked at our strategy, one of the things that we decided we must drive out is obviously our return to shareholder funds. And to do that, what was clear to us was that we needed to start leveraging our shareholder funds. That if we need capital, we should not be funding all of it from shareholder funds. If we can raise capital from bonds, that tells us that we can then channel greater return to our shareholder funds, and that's what we have done. So yes, this is probably the first time we have come out clearly and said, going forward, our capital is going to be funded through a mixture of equity and debt.
Retail banking, you haven't played a very visible role in that space. Any change going forward?
Well, I think you see us a lot more active in that sector. I think, as you know, earlier in the year, we came out with a move to now strategic intent, which was, addressing the time value of money and trying to we were very focused primarily on retail customers when we launched the move to now. Our digital channel migration and investment continues to be very strong. But more importantly, as I mentioned before, some of the investment we're going to make going forward is going to be expansion of our branch network. Branch network, by design and by definition, target the retail and SME segment because they serve a catchment area. Corporates all tend to be, 80% of corporates in this country are in Nairobi, so no issues there. But for us, expanding our branch network is to serve those retail customers. We'll also come up with, more exciting products for the retail market. I am very clear that for our next strategic cycle, we must become a significant player in retail and SMEs.